risk premium. And then the website is tailindex.com. That's what we called it. And it's running at the Kellogg School. And I'll just hope to give you a very quick introduction at the end to what is available there. And you are free to take advantage of that. It's all for free. So the talk today is not exactly about new papers. It is a merger of two empirical papers that are based on the inference theory we have developed over a number of years using option panels, which is a sequence of option surfaces observed over time to draw inference about the risk neutral density and aspects associated with it, and then try to use the measures that come out of that for some interesting financial and economics purposes. So they really represents joint work with Nicola Fusari, Viktor Todorov in particular. Rasmus Vaneskov has joined us in later years. And the stuff I'll present on Japan is joined with Masato Ubukata. So quite a few people have contributed to this. So without further ado, and because there's a lot of slides, and I will do it in a kind of a breezy, I hope, relatively easy and intuitive manner instead of getting bogged down in details, I will move forward fairly rapidly, but there will be 3 breaks where you can, raise your questions or I can take questions. So, as I said, starting out, we spent quite a few years thinking about a way to extract information from options and option surfaces without straitjacketing the information too much from information from the underlying. We thought we found aspects of the option surface that seemed to not be spanned by state variables you could extract from the underlying returns and volatilities. So what we ended up with was using high frequency and panel data econometric techniques to take to these option surfaces and extract information, assuming nothing essentially about the underlying model, meaning that under the physical measure. So it is purely a matter of using the option surfaces, and then to the extent we use the underlying, it's purely non-parametric techniques that's used. What this approach allowed us to do, we found, was that you get a pretty clean separation of aspects that speak to the jump activity under the risk neutral measure and the spot volatilities. So in particular, aspects of these, the jump activity in particular, are not easily found from the underlying asset dynamics. So it's simply invisible. And we feel that to be successful and emphasize the aspects that I'm talking about today, it is quite critical that you don't straitjacket the exercise with a specific model under the objective measure or one that accommodates the fact that you also want the options to speak to what the risk neutral measure looks like. On top of that, we found that these unique features in the option tail become important predictors of the equity risk premium. This is a little bit of a fraught issue because our time series aren't that long where we have good enough option data to do this. But to the extent we have been able to robustify these things, it seems to come out pretty well every time. So in particular, we find that the tail is the part of the variance risk premium that has predictive power for future equity returns. That is, once the option tail and especially big, large down movements are a big part of the variance risk premium. And once you strip that out of the variance risk premium, there's essentially nothing left, meaning that the diffusive variance in its risk premium has very little to do with subsequent compensation for holding equities, the market portfolio. I will show you both parametric and non-parametric procedures that does this, not the techniques themselves, but outcomes, the empirical work, and you get more or less consistent results. And the bottom line is the out of the money put options, not the very extreme ones, but the ones that are pretty far out of the money, seem to convey information about asset pricing in general. And so it's not entirely segmented from the broader asset pricing issues. There's parts of the literature that tries to figure out why they are so expensive and kind of have more segmented market kind of explanations. We think, at least to some extent, that's not the whole story. There are many different rationales you could come up with for our results, but we will leave that for theorists and ourselves to ponder in the future. I want to simply take you through what we have found using these econometric techniques on the option surface. So the sample I'll be using, because I'm going to be looking at European data as well as US data for the same sample size. So for Europe, we only got good data from 2007 forward. So that's the sample, 2007 to the end of 2014. That gives us 8 years. And what you see on the left is for the S&P 500, the first day of our observations. So in early January 2007, you could see there are 6 maturities. If I use this pointer here, there's 6 maturities. And you see the typical implied vol, Black-Scholes implied vol smirks. Nothing unusual there. And it's a decent set of number of options. You could probably learn a lot from modeling those. The last day in 2014, you go to the right and you see almost a wall of black at the short end of the maturity spectrum. That is simply indicating these weekly options have been included and are traded heavily. So you see all the bid-ask quotes on those essentially make it almost there's almost no gap between the strikes if you look at it from a bird's eye view. And that's actually the asymptotic that we are using in building the asymptotic theory, that you kind of use an infill asymptotic approximation in the strike range. You have 250 strikes that is given maturity. It's almost as if we're seeing them continuously. But you can see even at all the other maturities out here, there are even more observations typically than you would have 7 or 8 years earlier. So we really have had an explosion in the amount of active quotation, certainly, and also to some extent trading of these options. Let me jump into the parametric approach we use. That will be the use in the European data, and then I'm going to go to Japan later and see if we get confirmation of the type of empirical evidence we have found originally for the US. So it is really not that complicated. We stripped it down to its essentials, only shooting for the salient features of these option surfaces, since we're going across countries and not all of them are quite as liquid as we see in the US. So it has just one volatility factor. So there's a stochastic volatility factor that describes the risk neutral standard deviation of the underlying. And then we have a jump. So it basically becomes a Heston model with jumps. Now, importantly, we are using double exponential jumps out here, not Gaussian jumps. That's something I can recommend to all of you. Please try and use double exponential jumps for the jump distribution rather than the Gaussian. The Gaussian will put you to -4 with a mode or something like that. And it would basically say you're more likely to get a -5% jump negative than a -1 or -0.5% or 1% positive jump. That's just counterfactual. So you're much better off choosing a better jump distribution, size distribution, where small jumps are somewhat more likely than large jumps in either direction. And then you can have negative jumps happen more than positive jumps because it's a double exponential. Anyway, let me not ponder that too much. What we then have is the standard Heston factor. And then we have only the negative jumps. We have co-jumping in volatility. When there's a negative jump to the index, when there's a negative jump to the index, we get the squared impact hitting the volatility. There's a loading coefficient on there. So we determine how much that jump size would typically be by pure statistics, part of the inference. And the same thing for this U factor down here. This U factor is a new guy. This is the one that's unique to the negative jump intensity. That's where we are going to separate jumps from volatilities in terms of the standard models. So it's a separate factor, and it's bounded below by 0. It diverges, or it converges down towards 0, but it gets boosted up by these squared kind of Gauss-like innovations. That is the innovation to return squared when there's a jump, and only again the negative jumps. And it has a different loading than up here. So there's one extra parameter I didn't write out in each of these. Otherwise, all the yellow here is the parameters of the model. Now, I've described kind of everything, except there's a leverage effect. Of course, these two Brownian motions can be correlated with the coefficient rho. And then the jump intensities, as in all affine models, are linear in the state variables. That's V and U. And it turns out when we do it empirically, all we need to do is get a intensity factor for negative jumps. This is our U factor here. And on the positive side, we don't want the U to impact the probability of positive jumps. It's a little bit like saying when the index, like a few days ago, jumped up a lot, volatility actually declines. It certainly doesn't increase. So we don't want an increase in volatility following a positive jump. That's what the data tells us. So we simply get a constant here for the positive jump sizes. And then on the downside, it's variable and captured with this variable jump intensity U. So that's the model. And U, maybe I should go back here. U only enters through this jump intensity. So the U is our negative jump intensity factor, and that's the role it has, and it's separate from volatility. So what you've seen is a model that, even though it's a little bit unusual in terms of loosening the ties between the tail and the diffuser volatilities, is still within the standard defined pricing framework, which is absolutely necessary if you want to do inference in a parametric setting. What it also is a little bit unusual is this is asymmetric response to volatility or volatility to tail events. There's a nonlinear amplification. We square the jumps when they feed into volatility and jump intensities. And we claim that that actually gives a much better first order fit to the option surface dynamics. But the key thing is the tail dynamics is different from the volatility dynamics that get separated out. And it's a relatively parsimonious model with 10 parameters. So very, very briefly about, I don't want to talk the theory, but very briefly about how things are estimated in the parametric model. So we have these option surfaces here, basically the same as you saw on the second slide, where you had the Black-Scholes implied skews. Each of those dates are represented here by just a flat surface, but what you have is maturity in one dimension and moneyness in the other dimension, and then it's different dates. And the dots here would then be, we observed an option there at the close of the trading day. This is the price of that option. So it's kind of a marked surface, if you want. And there can be different dots on different times. It's a very unbalanced sample, and that's fine. We're just going to use all the options we have available to do the inference. But the inference is done in a way that allows the state variable to be determined day by day, but the risk neutral parameters, there were 10 of those that I put in yellow on the previous slide, they are the same across the whole sample. So think of this as fixing a parameter for the risk neutral dynamics, and then each day you go and see, given those parameters, what is the V and U that will make the best fit on this day. You go to the next day and forget about the V and U that are here. You just find the V and U on this particular day that fits things best. And then you keep optimizing. Once you have those, you can then try and find a better risk neutral parameter that optimizes the whole optimization problem. And here, a little bit more formally, the state vectors V and U, very low dimensional. We express the option prices in Black-Scholes implied vols, just a transformation, monotone transformation. And then the way the estimation goes, which is actually feasible, this is our 5 parameter, the 10 parameter risk neutral density parameters. Here we have the state vector observed each date we estimate for. So there's a lot of those. That could be 400 or 4,000 different surfaces that we are estimating for. What we do is very traditional here. It's a nonlinear least squares. We just try to get the observed prices of the options here to match the ones implied by the model. Since it's an affine model, we have almost closed form solutions. And if you write very efficient algorithms to get that pricing out, you can do that in fractions of a second. So even though there are millions of option prices being evaluated, estimating this, it's actually feasible. There's a little extra penalty term. Let me not talk much about that, but it actually imposes a no arbitrage condition that the underlying spot volatility that you can estimate from high frequency data on the underlying should match the extracted spot volatility from the option surface. And use infill asymptotic to get the asymptotic of that guy, infill asymptotic to get it here. So we get this nice stable convergence, and you can actually formally build tests, even though the state variables are random variables each time, each day, which usually would complicate inference dramatically and almost make it infeasible. This infeasible asymptotic is the key to get this to actually give you what's called a mixed Gaussian limit distribution. And you can do formal tests and inference on the parameters and the state variables day by day. You can check the fit of to the option surface in certain parts of the option surface day by day and so on. So it gives you an ability to do formal inference. Okay, so we obviously are inspired by an enormous amount of previous literature and a lot of people checking into the talk today as well. So let me simply not mention any of you so I don't forget any of you, but I recognize that that's kind of rude. Here are the references behind what we have been working on over the last 6-7 years, I guess. Number 1 and number 4 is with theory. 2 is really the paper where we come out with the inside VAV predictability of the equity risk premium, and the two of the papers down here are the ones I'm mostly talking about today. And we are looking at expanding on testing for dependence in the observation errors, which is also something that kind of goes into the inference problem. And that's about it for the theory and how we do this. So we have this model. It features volatility and jumps, diffusive volatility and jumps. Those two factors are claimed to capture at least the salient features of the dynamics of the option surface across time. One factor is the spot volatility. Other is this spot jump intensity that governs the probability of getting large negative jumps. And you get this self-lactation happening because if you have a jump, the squared part of that feeds into the jump intensity and the volatility. And when the jump intensity is higher, you have higher chance of getting another jump, which then elevates the jump intensity even more. So you can see you get this typical self-exciting feature, which we argue is critical in order to even make headway in terms of fitting what comes from the option surface dynamics. And again, there's no assumptions on the underlying dynamics. So without further ado, let me just show some of the empirical results we get out of this. And this is based on the same sample as we used for the European options. So it's not taken from the JFE paper. But what you have here is the diffusive volatility that's extracted. And you can see you don't need the coherence that comes from a time series model. This is estimating the state variables day by day. And you get a very nice depiction of what the diffusive or the spot volatility looks like. And that seems realistic. And I would say that this is a good candidate competitor to any Gauss stochastic volatility model that tries to extract volatility factors from the underlying. The second here is our U factor. So that is the negative jump intensity. And of course, it's highly correlated with the volatility. The two things are certainly not independent. We will see is that the decay here seems to take longer. You get a pretty quick, almost geometric kind of decay here and here. Here, the spike isn't that big. It manifested itself much more in the tail when we had sovereign debt crisis in Europe, for instance, which are these two incidents here. They show up more in the risk noodle density. So if you do a regression of the jump intensity on the diffusive spot vol, you get residuals that look like this. So the interpretation of what I call U tilde is what's in my left tail factor, jump intensity factor, that is not captured by volatility. And what I'm going to do is I'm going to ascribe all the explanatory power that's common between these two to diffusive volatility, and only the residual that we have extracted as a jump tail. So this is the part of the jump tail that's not linearly spanned by the volatility factor. And you can see it has these persistent kind of spikes. And that's going to be, our clean, in some sense, tail factor in the parametric setting. So the way we then move forward towards getting some economic content out of this is that we let me just remind you the standard equilibrium and reduced form settings in this fine framework would typically imply that the state variables are the ones who drives the future risk components and the compensation for risk. So by and large, you should be able to take the excess return on the index, the equity index returns over the future H weeks that we measured in weeks here. And you should use the state variable at the original point here, the starting point T, to predict. So we have this standard linear predictive regression that we run. When we did it out of sample in the US case, we got very good predictions out of sample as well. So that doesn't seem to be a problem. The factors are extracted quite robustly, and this relationship seems to be consistent. I'm going to show you the results in a moment. We also take what I call the risks. They are the realized volatility over the next 8 weeks. So they consist of the squared diffusive variation, and then the squared jumps, right? So the quadratic variation of the diffusive terms and the squared jump terms. And so these are, quote unquote, the risks that we see. And again, let's see if they expand or linearly expand by our risk factors. And here is what comes out. If you look at the equity, the excess returns, the only factor that comes out very significantly after 7, 8, a couple of months, right, 8, 9 weeks, and stays very significantly positive all the way out to about half a year, is the U tilde factor. The diffusive volatility factor has nothing, seemingly, at least in terms of significance, to do with the future equity excess returns. Here, the R squares, and you almost pick up none of the R square by including that factor. All of it really comes from the jump factor. The exact opposite happens if you look at what the actual risk that materialized over the coming months. Now, it's a really easy thing over the wild sample period that we have, including the financial crisis, to get a high R square. You just have to have a high volatility forecast, and volatility is high, and you're going to get a high R square. But what's very striking is that now the jump intensity factor has absolutely no ability to forecast the realized variance going forward. So it doesn't even help forecasting the jumps that are happening in the future. The volatility factor does all of that. So there's a huge separation, a very clean separation between what factors seem to drive the actual risks we see and the ones seeming to explain or correlate with the premium that you realize holding the equity index itself. And you know, it is somewhat consistent with the fact that when people try to use volatility extracted from the objective measure, they have a hard time finding significance for the realized equity premium going forward. This says that that relationship isn't there if you try and use a quadratic variation to find out jump intensities and diffusive volatility. You will not find that jump into left tail jump intensity factor because it doesn't explain it under the objective measure. It only exists, at least in a significant form, under the Rich-Noodle measure. That's as far as we can tell. So the key to all of this has been we did not tie ourselves to identifying the state variables from the underlying at all. We let the option data speak quite freely about what factors we need. And that leads to these implications about the separation of the left tail and the jump factor in terms of relative to the volatility stuff. So that's kind of the background talk or presentation. I will go into the empirical evidence both for Europe and Japan now, but I think this is the time to pause for a couple of questions, if there are any.
Yes, so there is a question from Da-Chung Xiao. It says, sorry, I can't read it right now. It says that there are many jumps in the estimated U factor, which moves upward only when there are jumps. Does every upward change in U imply that there was a jump?
We could probably go back and look at that, but remember, we do not do inference on realizations of jumps. We are extracting the jump intensity, and it's true that should jump when there should be a jump in the underlying index. So one could go back and do that exercise. I don't think we have particularly focused on that. So I can't answer whether that's exactly validated in the data or not to the extent that we can do it carefully. So we haven't done that.
Okay, and then from Mike Chernoff. I'm confused by the notion of out of sample here. Are the parameters and states re-estimated every period?
So the out of sample was strictly on the evidence that is reported in the JFE. The sample for Europe is too small to start doing too much of a splitting. So what happened in the JFE paper, and we validated that later on, but what happened is that you can fix the risk noodle parameters as they are estimated up till the original sample we had, and then you can let the sample run for another, I think we did close to 3 years, where the risk noodle parameters were not updated, but you do update, of course, the state variable is given those risk noodle parameters, you find the optimal V and U on each date that you observe the option surface. Exactly as you would do when you're doing the estimation. Okay, but it's out of sample in the sense that we are not estimating the risk neutral parameters. We are only extracting at time t, the state variable, and then we're looking 6, 7, 8 months out between, well, 1 week out to, I think, 26 weeks out. And the state variables fit the realized volatilities and the diffuser volatilities equally well out of sample. And if anything, we did equally well, to put it mildly. And what it speaks to is if you have a long sample, the risk noodle parameters, at least the ones that really matter, seem to be quite stable. They're quite well identified by the option surface, or option panel, I should say.
One more question. So from Bjorn Rocker, so the R squared seemed very high at more than 20% for 15 to 20 weeks out. Would you like to comment on that?
Nah, I would prefer not to get too much into what we would expect out of sample. I do think that there is it must be exaggerating somewhat what you would expect in the long run. All I can say is that as we take it to more and more different countries with somewhat uncorrelated factors and other things, the significance seems to remain, but I'm sure I can't say anything unless I wait another 20 years to fundamentally address Bjorn's issues about is this statistically significant? Is it really there? What I can say is that to the extent you believe that the variance risk premium does predict anything, the ability of the variance risk premium to predict anything is all condensed into this tail factor. I'm going to show you that.
All right. I see that we're only on slide 14 and you have a lot of slides left to go, so maybe we should restart.
Yes, I think we should. So the question really is, and this is partially to start addressing what Bjorn is implicitly bringing up, is the evidence US specific? Is it only on one particular sample? And let me not ponder this too much. Let me simply jump into the indices that we looked at. So this is the 8-year history for the European indices and the S&P 500. You could see the Italian index lost about, in terms of cumulative returns since the start of 2007, 50%, whereas the German index gained maybe 60%. So there's an enormous diversity in the performance here. Now, it's important to understand we are not trying to explain the realized equity risk premium over the period. There's lots of negative shocks that hits that. What we are trying to say something about is the correlation between our factors and future returns. So the more important thing is once you get hit and the tail factor responds correspondingly, are you getting higher than usual equity returns going forward? And that's what we can seem to verify across these pretty diverse performing, but clearly somewhat correlated indices. So without further ado, we use more or less the same filters, standard filters. Here are the spot volatilities extracted from the 6 surfaces, or the 6 option panels, I should say, for each of the countries. The striking picture is compared in each of the 6 panels with the corresponding measure for the S&P 500. And for the first 2 to 3 years, there's absolutely no deviation between what you see from the US evidence and what you see from the ones we extract independently in Europe in different countries. They're remarkable even to the level almost identical. After that, you start seeing deviations that are fun to talk about. Let me just notice here that in Italy and Spain, the ones really hit by the sovereign debt crisis, you do see, especially in Italy here, sharply elevated volatility over that period. If you go to the negative jump variation, again, they are kind of on top of each other in the beginning. At the end, you see Spain here really going crazy in terms of the implied jump intensities, whereas they are kind of lower in Switzerland than the US. They are much, much, much higher in Spain. And I think that intuitively is what you would expect if you recall the talks about a southern euro maybe happening and Spain leaving the euro and things like that. So we repeat the exercise in terms of outer sample predictability. And first we look at the return variation. So can our V and U factor predict the realized volatilities over this sample? And we find, like we did before, the tail factor, the left tail factor, has no explanatory power whatsoever. It lies in this insignificant region, but the volatility effect, the diffusive volatility, captures all of it. And you can see here over here in terms of the R squares, there's just no difference, and it happens 6 times out of 6. So the tail factor that we extract solely from the option surface has nothing to do with what you can extract, at least statistically, from the underlying dynamics of the equity index returns themselves. So you would miss it. You would not see that factor if you did inference strictly or extracting factors strictly from the underlying. But when you go and look at the excess returns, and here the R squares, Bjorn will be happy they're a little bit lower. They're probably still higher than he would be comfortable with. And it can very easily be that this in-sample aspect to this contributes somewhat to that. Nonetheless, you see that the R squares that is here is all explained again by the left tail factor. So the left tail factor that doesn't show up in the underlying dynamics is the one that correlates with the drift term or the expected returns. And it happens 6 times out of 6. And let me not ponder the evidence more than that. Let me just say that predictive regressions in this international context for the European indices that experienced very different histories over the financial crisis and subsequent sovereign debt crisis is by and large qualitatively entirely consistent with what we, on a different sample, extracted from the US earlier, and then we repeated again here for the US as well. And so again, the key thing is that we have a separation of risks and the risk pricing. And without further ado, let me jump to the next little topic here, which is, okay, if we're in these settings and we found a state variable or a risk factor that predicts returns, the way we usually cast things is that we should have a risk premium for that factor that explains or economically captures this intuition. So in this case, if it's a tail factor, we would look at the negative jump risk premium. So that's the piece that would be a part of the variance risk premium, right? But it's a negative jump variation. So basically the things that comes from large negative jumps under the Q measure minus the same thing expectations under the P measure. In our model, you can actually estimate this negative jump variation factor directly as a linear function. It's just a scale version of the current state of the jump intensity that only depends on the maturity you're looking at. So 8 weeks out, you have a different, it's a function of all the relevant parameters, but once you have the parameters, this is a constant. So that is very easy to get this Q measure for the negative jump variation once you have estimated the model. Under P, unfortunately, that's a very noisy affair trying to predict negative jumps under P, and as you know. So we use the simple kind of harm thing dedicated for the jumps, but it's probably a little bit noisy. What really matters is that the Q measures completely dominate the P measure. So the risk neutral density has much more of a tilt to the left than you will ever observe in the underlying. So you get patterns that look very much like our jump intensity itself that you've seen before. So let that be enough. And then we then show you what happens if we compare the variance risk premium. You will find, this is for many months out, but you will find statistically significant indicator the variance risk premium predicts the future equity returns going, this would be 7 months out or 4 months out, at least in most cases. But once you combine it with the negative jump risk premium, the negative jump risk premium takes over and becomes the only positively significant variable, and you get a huge jump in this R square. So the variance risk premium is not doing anything, but the tail factor is, or the negative jump risk premium is, and that is consistent across our 6 indices as well. And given the time constraint, let me not ponder that anymore, but that's basically when we run these multiple regression comparisons, the orthogonal piece that comes from the tail factor that's orthogonalized, at least linear, and it doesn't have anything to do with the linear span of the volatility factors, then you get the significance of the left tail factor. So let me take a small pause here again. Let's try and make it small because I have more slides.
Okay, so a simple question. So maybe not a simple answer though. The left tail behavior in your model is like what happened after the 1987 crash. Have you looked at that?
I forget if our first paper went back that far, but the option coverage is kind of problematic at that point. So we certainly don't have nearly as much robust evidence going back that far. It's much harder to identify the tail. And as you know, the markets kind of went crazy on that particular day, or a couple of days.
Okay.
So, let me basically just pass on that. That was a poor way to answer, but.
All right, and then one other question. Is some of the variation in the time series that you compute correlated with sentiment indices from news or social media?
I think we did some of that, and the answer is that there are some indices that it is correlated with. It's too long ago that I looked at that I can completely recall that, but I think that is a very interesting thing to pursue, and I am confident that we found some quite significant correlations. I think the credit spread was probably the most significant one, and you can kind of include the credit spread in these kind of comparisons. We do better, but the credit spread was quite correlated with our tail factor.
All right, so that's it for questions now. You have between 10 and 20 minutes left, and what I mean by that, a hard stop at 20 minutes.
Okay, thank you. So without further ado, let me jump to Japan, because Bjorn and others will probably say that, gee, these things are very correlated. It's not really, quote unquote, out of sample to go to Europe over the same period. And indeed, we saw that at least in the beginning of the sample, the markets behaved almost identically. So where can you find good options data that you can use for this type of exercise that can be used as a little bit more independent check? And we landed on Japan. Masato Ubukata was visiting us and presented a paper on the variance risk premium not forecasting anything in Japan. That's been found before in the voluminous literature that is on the variance risk premium equity for forecasting equity returns. And it doesn't quite work for Japan. To the extent it does, it's only on a very small subperiods. That fits into a huge literature that have found that equity index returns in Japan are very, very difficult to predict using almost any of the typical macro finance predictors that people have used and found success with, broadly speaking, in other countries. So it sounds like it makes sense to take a more serious look at Japan. This is just, so you can look at this for yourselves. This is simply a list of some of the studies that have tried to use different variables to forecast the equity index returns in Japan going forward. And at the very bottom one, you have Ubukata's own work with Watanabe, and that's where they had the variance risk premium in Japan, not really doing so well explaining things. So let me summarize the evidence we find in Japan before delving into the details. So at least I will get that across. There's much more country-specific variation in the variance risk premium and the left jump variation tail measure than we found for the European countries versus the US, which is a good thing. On the other hand, there's some extreme outliers as well. So we actually, when we do the regression, we will windsorize as well to make sure that it's not driven by some peculiar feature in the data that generates extreme outliers. But basically here you could see some specific events in Japan that makes the series look very different from the US. So we get much more heterogeneity out in the comparison between the US and Japan than we did versus the European countries. We are going to find that a country-specific regression for Japan that's done exactly as we do it for the US and the individual European countries will fail to produce predictability. But the big twist we have is that if you use the US the tail factor, then suddenly we start being able to predict the Japanese excess returns. Maybe surprisingly, I don't know. In particular, if you convert the Nikkei returns into dollar denominated returns, just converting at the appropriate exchange rate, then we find very strong predictability. And then you ponder how the heck can that happen? And the best explanation we have without it necessarily being theoretically fully tight is that the Japanese index is extraordinarily, or the Japanese options market are very global, meaning over 90% of the volume is on behalf of foreign entities rather than Japanese-based entities. So we kind of think of the Japanese pricing intuitively as being very influenced by global conditions, and you can kind of think of the US tail factor as being a proxy for global risk appetite, if you want to call it that way. So that is at least a hypothesis that that one could pursue following this. Here we're going to do the non-parametrics. I said we will do parametric and non-parametric procedures. So we're going to do a non-parametric procedure. So basically the jump measure is going to be characterized in the tails for sure by this this extreme value theory approximation that works really well empirically, that basically said the log option prices should be linear in the tails. And according to the representation here, we have the negative jump intensity factor, phi minus here, and then alpha gives you the shape. This is the exponential kind of decay pattern. That is now alpha minus, but we put a T on it. We now allow the jump size to change day by day as well. So that's the beauty you get. You don't have to estimate a non-parametric model. A parametric model, you can do this non-parametrically day by day, and just you looking at the tails, if you have enough out of the money put options, you're going to be trying to calibrate these two parameters to what you see in the tail. And the formal way it happens is that you can estimate the alpha, the decay of the tail, directly by taking the log of the option prices at two different strikes out in the tail. As you're moving further and further away, you're just getting the slope here because you get the log option prices at the two different points divided by their difference in terms of moneyness or a strike. So it's literally the slope of that linear line, and that gets related to the alpha minus parameter. So the alpha minus parameters tells you a little bit about the heaviness of the tail, right? So you extract that first, then given that estimate, you plug it in, and then you look at how high is the tail located, and that's how a phi parameter, the probability of getting a negative tail realization. So it's more in the spirit of what the U factor was before. We have that flexibility on the jump size distribution also changing now. But that's really the procedure. And once you've estimated those two parameters, you can actually get the left jump variation tail just as a function of those two parameters in closed form. So this is a very different procedure. Here's a description of how we actually implement it, but let me not ponder that for too long. Let me jump directly towards the evidence. We run the same type of predictive regressions where this X now becomes the regressor. And that could be the variance risk premium. It could be our left tail factor. It could be all these different things you want to try and explain the excess returns with. And we do the inference as best we can, being sensitive to the persistence that you see in the data. So here are a bunch of newly developed techniques that should be more robust to persistence. The results don't change. So here's what you get. If you do this for the US, and this is kind of a robustness check, you find again that the left tail factor comes out significant in the excess return regressions. And that happens both when you winterize and you don't winterize, and for a subsample or a longer sample. If you do the same thing for Japan, an utter failure, and I kind of preempted that conclusion before, but you see the t statistic of 2 is up here, and nowhere over the first many weeks and months do you get anywhere close to that. And also NAS squares is kind of relative to before very weak. So that's consistent. The left tail factor in Japan in and of itself do not forecast the equity returns in Japan. So I had this claim that foreigners trade a lot in Japanese equities, and here are the percentages of the volume in the put and the call options on the Nikkei 225, and you see the percentages in recent years being well over 90%. So you can have this perspective that global investors are the ones that are the marginal investor and pricing the equity options effectively in Japan. And in that case, you would kind of want to look at the returns on the index also with foreign eyes. And if you do the dollar-denominated Nikkei index and use the left tail factor from the US, so the global risk factor forecasts the dollar-denominated returns in Japan extraordinarily well. And actually more significantly than we did the same thing for the US. If you're just doing it with the Japanese denominated returns, we still get kind of marginal significance, but not quite as much. So, wow, that was interesting. If we take the variance risk premium in the US and take it to the US dollar denominated Nikkei returns, big failure again. So again, it's a tail factor in the US, this orthogonal piece or part that's not part of the variance risk premium that has the explanatory power. And that was an attempt to kind of cover this relatively quickly. Any questions at this stage?
Yeah, so there was another question from Bjorn that I may have overlooked earlier. So maybe it's a little bit out of context now, but it was the previous results, I think this is the earlier results, were from the V and the U, but now you're non-parametric. What is the relationship between the two?
It's hard to formalize. It is two different empirical ways of getting at what happens in the left tail without imposing any parametric assumptions on the physical measure. One, you are a little bit hemmed in by the parametric representation you do. So you might worry that some of the conclusions are driven by the parametric specification. The non-parametric approach only looks at the tails, and the quasi-parametric assumption there is that the extreme value theory has predictive power for the risk-neutral tails. Empirically, these option patterns look, these log option prices seem to decay very nicely linearly when you get close to the tails, and that's the only assumption that's used there. So it's two different ways of getting at a similar quantity, I would say. But you should think we are not stripping. We are using very short-dated options, so we shouldn't have much impact on the diffusive volatility out in the tail. But it's not impossible that we have part of the diffusive volatility sneaking in our tail measure in the non-parametric setting. There's nothing wrong in that. It's just that the other informative piece that's linearly orthogonal to the diffusive variance should have explanatory power, and that's kind of what we find in a different empirical approach.
Okay, and one more question, this one from David Bates. You have a measure of downside risk, that is left tail risk, that you attribute to jumps. If so, it should predict negative stock market jumps under P, does it?
I don't think it should. It doesn't have to. It could be how badly people feel about negative jumps in the current state of affairs. That's more my interpretation. So let's put it differently. Under the parametric model, there was a lot of correlation between V and U. And if I ascribe all of that to V, then V explains the downside jump probabilities quite well. And I hadn't shown that on the slide, but it does. So that also shows up as part of our left tail measure. What is unique is then when we look at the residual explanatory power, then it has no predictive ability. So yes, the left tail factor itself can be part of explaining it, but you might as well ascribe it to the diffusive volatility. And the unique part of it seems to have only speak to the premium aspect of it. And that's where we are shortcutting the typical approach that says state variables have to drive both the risk and the risk premiums. And essentially you get the risks and then you tilt a little bit to get the risk premiums and calibrate it to the options. That's where you're going to miss this orthogonal factor.
Okay, and one more quick question. Okay, maybe the U.S. tail factor predicts dollar-denominated Nikkei returns because it predicts the exchange rate?
Yeah, we looked at that, and if you go to the paper, you will, and it's posted on the website, you will see that there is some weak evidence of that. It doesn't do it nearly as well. So it does do it a little bit, and then it adds on to the predictive power for the Japanese returns themselves. So when you combine the two, the evidence looks quite a bit stronger.
Okay.
But just forecasting the exchange returns is it's borderline significant.
All right, I should let you finish then.
Okay, so I think I would have to, let me just not go over the conclusions. I think people can read them for themselves, so it should kind of be obvious by now. I want to go to this website that's called thetailindex.com. If anybody wants to peek at our measures, they are there. And I think I would have to go out and stop sharing screen and then go back in again. So let me do that as quickly as I can. So let me, I want that, I want this, and then I want to go back and do share screen. Okay, do you guys now see the volatility index of the website?
Yes, we've got it. We can see it.
Perfect. Okay, so I need to click something here. I need to move something around. So this is the front page you get when you go to derivatives page, market indicators, or the tailindex.com. I go to tail indices and click the button for charts, and this is what you get. You get a left tail volatility in percent for the S&P 500 index, and it moves forward and gives you the smooth version of that. If I click this little button here, then it actually pauses. Otherwise, it'll scroll through and give you a bunch of different indices. But this is our tail factor mapped from 1996. So you could actually start doing some of what Neil asked me about just using the series that's on the website. But this is the series we have up. So this is based on option metrics, I should say, end of day observations. For the S&P 500, we have a bunch of other indices, Dow Jones, NASDAQ, Russell, and then a bunch of ETFs on which there's also options written that were liquid enough that we felt we could do the tail measure. So what you can do there is if you click up here, you get the ability to print the chart if you wanted to, this smooth left tail index over time. You can download the image, obviously. You can also download the PDF, and you can download the underlying data to an Excel sheet. So, and then here you can kind of focus on a particular subset of the data. If I let it run again, you will see that it should start moving to a new index shortly. Okay, so let me click over here and we will see a new series. This is the 10% probability under the risk neutral measure that you over a week will drop by 10%. So there's a 3% chance during the financial crisis that you would have a 10% drop over the next week. And on an annual basis, that would be quite a lot of 10% downturns, but that's obviously an extreme observation. So You have the ability to download the data. There's also a methodology tab here that you can click on, and you can go to the tail index, and you will see the methodology written out. So here's exactly what we've done. If you want to download the code we use to generate the series, you click on download code, obviously. If you want a more careful explanations of the formula and how they derive, there's a white paper. So we try to live up to the standards of documenting these things reasonably carefully. Okay. Let me then take you back to the home, because in the long run, we hope to add some other things, but this is our tail index series. Victor has put up his spot volatility, diffusive volatility estimator as well. And so you can go in and download his spot volatility estimator. This is based on a portfolio of options, a little bit like the VIX, but it isolates this diffusive spot volatility. And that's the blue line. If you compare it to the VIX, you could see what the diffusive volatility is relative to the VIX over since 2008, I guess, it's reported these things. That's, I think, incredibly cool. These are very, as far as I can tell, very high quality estimators of the spot volatility, which is, by the way, common between P and Q. That's the equivalent probability measure property for the state variables. So you could use this literally as an estimate of the diffusive P volatility at the end of the trading day for the S&P 500. So we hope to add other, corridor volatility indicators and things like that to these measures as well. So that was my peek at that. I wanted to go back, if there's time, to my slides, and we will see. Okay. So excuse me for a moment. I want to go back and share a different screen. So share screen. Here we are. Okay, so I hope you see my screen again.
Yes.
Okay, so this is where I left you off. So the unfortunate part of the other stuff was that it only goes to the middle of 2019 because we're using options metrics data, and that's the last update we got. We did something, and I'm not going to vouch for the compatibility, but it's interesting to see what happened in 2020, right? And the pandemic. So here is the estimate of, here's just the VIX, and then the left tail index. So the left tail index started shooting up late February and had a very sharp peak here in beginning to middle of March. And then it fell down to a high level, elevated level, but quite considerably lower. The red line should be the average sample value of this index. So we are at an elevated level for the left tail index, but not at the extreme level that we had in March. And that's kind of our read on where we are in terms of that. So here is, if you did the same thing for the whole sample, the red line should be an indicator of the mean of that left tail series relative to the VIX over all the years. And where we are now, the tail index came up to the magnitude we saw for a single day or two in the financial crisis, but it has stayed above that for a number of years. Here's an illustration of what it looks like when we fit the left tail across 9 nearby maturities. You want to be as close to the shortest maturity you can without maybe using extremely short maturities. So this is 6, 8, 10, 11, 12, 13, 15, 16, and 18 days to maturity. And this is how we fit the tails as a linear function of the relative log option prices. And the negative line here indicates what alpha is. The steeper it is, the less thin the tail is, the flatter it is, the more fat tail the distribution we have out towards the left. So that's essentially how it's fit. And you can kind of combine the estimates across different maturities. And here's a curious thing that I will not vouch completely for the validity of this, but if you fit the smooth 10% probability for a down move over the whole sample, you get this pattern here. What we saw in the pandemic was an enormous increase right around the culmination of the crash of the US S&P 500, and then a very quick downturn as well. And that's kind of the picture we see, that we are down to an elevated but not extreme level. So the real fear vanished very quickly, but we are still at an elevated level. And that would be, in comparison to the financial crisis, kind of striking. Let me stop with that, but there's obviously a lot of things you could peek at, we think, using these tools. And we think the option surface tells you things that at least you'd want to know about. And the way of getting the inference from those is a little bit different than the old style fit the underlying and the options simultaneously, you relying a lot on the dynamics of the underlying. That can easily miss a lot of the important stuff. Let me stop with that and see if there are questions.
Any other questions? If you have a question at this point, you should feel free to unmute yourself and ask it orally.
Torben, this is Chris Jacobs. Very quick question on that last graph you showed us about the pandemic. Did that probability shoot up right before the market came down, or contemporaneously, or just after? It's hard to see. And what's the frequency of those data?
Yeah, it's smooth, and I even forget what the smoothing is that we usually applied. I should have gone and shown the team behind the website. So we have relied on both Wendu Jiang to do a lot of the organization and updating, and he's very nicely produced these at a very short notice. I don't actually know what the exact smoothing here is. What I do know is that it spikes much, much more than you see here. So the fact that it's stops at only 8%, I think it hit 30 or something like that. So it would have said that in the wildest days when the market was dropping like crazy, the options were indicating under the risk neutral measure that you had an almost 30% chance of seeing a down move of 10% over the next week. And which, given the nature of the fall, might not seem that outlandish. You know, prices were falling 5, 6, 7% a day, not a week. But pretty extreme. If you extrapolate that on an annual basis, you know, that is, I don't know, there will be tons of weeks, like a third of the weeks would have moves of down 10%. That obviously is not. You know, we all know the danger of annualizing these numbers. It is a state variable over the near future. But you're right, this is a smooth picture, not to make it look distorted. And I'm a little worried about the integrity of the data that we download from Bloomberg. So I wanted to keep it here at the end, and let me put a caveat out that I would like to see the corresponding options metrics data or data from another source. The compatibility of the two series is not perfect.
Thank you.
So this is indicative.
Torben, Steve Figluski here. Two things. One is about the crash of 1987. That data does exist. The Berkeley options database had that data, and there was plenty of it. And what happened in 1987 was that we went from seeing a genuine smile in the options market to a skew with the left tail much more emphasized. And that persisted for a long time in ways that nobody could explain in any kind of, you know, standard parametric way. A second point, which I think is, that's something to think about. But if what you're getting at is a sentiment, a risk aversion, a risk premium, left tail, it's natural that any kind of equity market where the world is long equities is going to worry about the left tail, prices going down more than prices going up. In markets, in other markets, you worry more about the price going up. For example, if we're thinking about an agricultural market where there's a crop failure, the price goes way up. So it should be a right tail effect, and you might see your factor affecting a right tail. Similarly, for the VIX, for electricity, those have right tail risks. And when you think about exchange rates, you could have risks of jumps in either direction, and so you might have this kind of thing in both tails.
I completely agree with the second comment. It's very well taken. This is definitely equity specific. I don't think we see many other markets that have a skew that persists like this since 1997, and that's also a good point. That's when that originated. The problem with doing the parametric model in 1997 is that our option data kind of starts in 1996 in terms of being liquid. We do need a period to estimate the risk neutral parameters before we start doing the exercise. 97 comes very early. Second, the tail coverage isn't really that good at that time. So you can do something, and maybe we can try and fit the tail measure at that point. And I think that would be an interesting exercise, non-parametrically.
It's 87, not 97, and you'd have to go before the.
Oh, 87. You think about 87, not 90. Yeah, 87.
Yeah.
Skew king. I think you said 97, but yes, no, 87 would be interesting. And okay, that sounds like a fun project. I can't speak to the quality and liquidity of relatively short dated, way out of the money put options at that time, but it would be worth peeking at. I agree. And your point about different asset classes and maybe the right tail being more interesting, it's trivial to, in principle, to extend everything we've done to focus on the right instead of the left tail, or even both, right? There's nothing unique to the left tail in what I've done, except that's what came out from the inference.
All right. Are there any other questions?
I have a question.
Please.
Torben, I downloaded your data, as you know, a while ago from tailindex.com, and I must have used the wrong data because I was not able to get an R-square that exceeded 4% at the 12-month horizon using the data for the S&P 500.
12 months. I don't think we report much going out 12 months. So.
Well, my point being that was the highest one, and at the shorter maturities, it was lower than that. It was like 2 to 3%.
Clearly, it is hard to predict things. So we can certainly try to reconcile those things. If you get in touch with us a little more specifically, we can, swap explicit data and see.
Just to clarify, when you're showing us the first part of your results, when you have the R-square is above 20%, that is for the U and the V that you're estimating day by day from the parametric models.
Right.
But then on your website, the tail index, there are various time series there. So
we do not have the parametric stuff on the website. It is
right.
the parametric measure.
So that's
you can go back and replicate the 20%. That's correct.
But the ones that I downloaded, I noticed that when I included the more recent the data that was up until 2018, that's when the R-squares dropped from something in the 10%, 9% range, if I can recall correctly, down to 3 or 4%.
Right. My guess is the pandemic will help us later on. It is a little bit sensitive to the subsamples or particular sample periods you're looking at. I don't know what to say except that this is a complicated exercise, but I think the level of significance we get across different indices around the world is indicative of something. But again, yes, if you slice and dice the data in different ways, you will find different levels of significance. It is a somewhat fragile thing, and we will just have to wait for longer sample periods with enough strong signal to noise episodes before we can fully sort this out, I think. But I think it's still very indicative of stuff that's happening. So you can be a skeptic, and I understand why, but I still think there's lots of inspiration to pursue that gives good economic sense, makes good economic sense, whether the R-squared should be 20% or not. Well, probably not. That's probably a little bit of a lucky circumstance. I agree with that. That seems excessive.
So I'll jump